All right, let's talk about Danaos Corporation's latest earnings. Their Q2 numbers just dropped, and honestly, they're a bit of a head scratcher. You've got this conflicting story on one hand, but then management steps in and lays out a super clear strategy for navigating what's, a pretty tricky shipping market right now. So let's dive in and unpack what's really going on. So here's how we're going to break it all down. First, we'll hit the numbers, the good and the bad. Then we'll get into management's playbook, which is really interesting. After that, we'll look at this disconnect, what the company is saying versus what the market is worried about. We'll check out how the stock reacted, and then we'll wrap it up with our take on what's next. Okay, first things first, let's get into the numbers. And this quarter was, it was the classic definition of a mixed bag. You had a beat and a miss, a real split decision. And yeah, that's the central puzzle right here. The headline story is, it's mixed. The revenue number looks fantastic, really strong, but then you scroll down to the earnings per share, the bottom line, and it kind of falls short. So right away, you have to ask yourself, okay, what's going on between the money coming in and the profit they're actually keeping? So let's talk about that miss first. The street, the analysts, they were looking for $6.66 for adjusted EPS. Danaos came in at $6.36. That's a 30-cent miss. Now, look, it's not a massive disaster, but in this kind of market where everyone is watching for signs that things are slowing down, believe me, every single penny counts. But then, you've got the other side of the story, revenue. It came in at over $262 million. That's a solid beat, $15 million more than expected. So they're clearly pulling in more cash than anyone thought they would. This is the really good news that kind of got buried under that earnings miss. Okay, so this table is where we start to solve that puzzle we talked about. See that revenue line? Up a nice 6.4% from last year. That's great. But then, look at the adjusted EBITDA. It's basically flat, down just a tiny bit. So what gives? Well, the CFO broke it down on the call. It turns out that rising costs, things like running the ships and paying for financing, they just ate up all that extra revenue. One key thing, though, they kept the dividend at 85 cents. That's a pretty strong signal to investors that they're still confident. So you see the numbers, you see the cross currents. How is the company actually navigating all this? Well, that brings us to their game plan, what we're calling management's disciplined playbook. It's all about strategy over speculation. They're not just chasing the latest hot trend, they're playing the long game. And this quote from the CEO, Dr. John Gustis, says it all, really. He's basically saying, hey, we're seeing a lot of hype and speculative buying, especially for these smaller feeder ships, and the prices just don't make sense to us. So while their competitors might be jumping in, Danaos is stepping back. They see a bubble, and they are refusing to overpay. That tells you everything you need to know. They care more about smart investments than just getting bigger. So let's break that playbook down into 5 key moves. Number 1, they're locking customers into longer contracts for more stability. 2, like the CEO said, they're avoiding all that speculative ordering. 3, they're focused on cashing in on their enormous $3.6 billion revenue backlog. That's money already in the pipeline. 4, any new ships they do build are green-ready, eco-friendly, which is a huge deal for customers now. And 5, it's all about keeping their finances strong, which gives them the freedom to wait for the right moment to act. So this all leads us to the real core of the Danaos story right now. It's like you're standing on the bridge of the ship. Inside, management is looking at their charts and feeling super confident. But outside, the broader market is looking at the horizon and they're seeing storm clouds. It's confidence versus caution. And you can really see that split right here. You've got 2 completely different stories fighting it out. In one corner, you've got management's confidence, and they're pointing to that massive $3.6 billion backlog, the fact that they're basically 99% booked for next year, and they have this modern green fleet. But in the other corner, you have the market's concerns. They're worried about too many new ships flooding the market, those rising costs we talked about, geopolitical risks, and shipping rates in general starting to cool off. So with these 2 competing stories, how did the stock market react? Who did it believe? Well, the reaction was, it was pretty telling. Basically, a big shrug, a very muted response. Now, if you look at how the stock was doing before this report, it was actually doing pretty well. Over the last 3 and 6 months, it was keeping up with, and in some cases, beating the big shipping ETFs. But the reaction to this earnings report, it wasn't another big jump. It was more like the market hit the pause button. In fact, on the day of the earnings call, the stock barely moved. It closed up just a tiny bit. and a lot of people were trading it, volume was high, but at the end of the day, the market just sort of collectively decided it was a non-event. What that really tells you is that investors are more focused on the big picture, the potential for the whole industry to slow down, than they are on Danaos' very impressive backlog. The big wave is more important than the strong ship, in their view.
All right, time to put it all together. This is our final section, the next call. We're going to give you our take on what to expect and our rating on the stock.
So, yeah, what is the call for next quarter? What should you actually be watching for? That's the billion-dollar question, right? Look, our prediction is pretty simple. Expect more of the same. That huge backlog means their revenue is going to be solid and predictable. It's like a safety net. But those pesky operating costs, they aren't going anywhere. So we're probably looking at another mixed quarter. And for the stock price, it's probably going to be stuck in a range, just bouncing around. It's that classic tug of war, the safety of their backlog pulling it up and the broader industry fears pulling it down. So that all leads us to our official rating, market perform. Let me be clear, the company is doing a great job executing its strategy, but they can't defy gravity. They're part of a bigger industry, and that industry has some headwinds. So, thanks to that backlog, we don't see it falling off a cliff, but it's going to be really tough for the stock to be a superstar until those bigger industry clouds clear up.
Now, with all that in mind, let's talk about a potential trade idea. Our whole thesis is that the stock is probably going to trade sideways for a bit, right? It's stuck in that tug of war. So one thing you could consider is selling covered calls. Basically, if you already own the stock, you can sell someone else the right to buy it from you at a higher price. Why would you do that? Well, you get paid cash, called a premium, right up front. The whole idea is to generate a little extra income while the stock just chops around, taking advantage of the fact that it's probably not going to have some huge breakout anytime soon.
So, the big question is, can that disciplined playbook keep shielding them from the industry's choppy waters? We'll be watching next quarter to see if the ship can hold its course. And, of course, a reminder, this is not financial advice.